Okay, welcome back, guys. Welcome back to the Proudly Made in Africa podcast. I'm Raj Maverick, and today I'm excited because we have a fantastic guest in Sophie Papasavva. Sophie is a founding partner at EMFC Loans, where they help facilitate financial access and sustainability development for African enterprises. Today, we want to look into breaking down some of those barriers and opportunities for these African enterprises on the continent. So, thank you once again for joining us. It's a privilege to have you here with us today, Sophie.
My absolute pleasure, Raj. My absolute
Awesome.
pleasure.
So, Sophie, could you start by giving us that high-level overview of, EMFC loans and what led you to specifically focus on the African market?
Indeed. So as long as you don't hold it against me, Raj, I will disclose I am an ex-banker, spent several years working in banking out of London and New York. And then I went and set up EMFC about 14 years ago, basically drawing on all of my experience of having helped companies raise debt in Western, Eastern Europe and Latin America, plus about 5 years spending time with a South African bank trying to raise loans on the African continent. I quit my job, went off, did some charity work and set up EMFC. And what I've been trying to do for the past 14 years is help level the playing field, let's say, for fast growing African companies that haven't historically had the access and or the privilege of fit for purpose debt to help them grow and deliver their strategies.
Okay.
So we focus on helping those fast growing companies speak the language of lenders. Most of the time, those lenders being international lenders, so sitting abroad, away from their target borrowing audience. And very often development finance institutions who are very, very keen to lend into Africa.
Awesome. And are there other companies like EMFC Loans here in Europe that are looking into Africa as well?
Very few, I'm afraid to say. And it is actually a barrier because the companies that most need our services don't even know we exist because that niche, specialized, sort of bespoke know-how of bridging the gap between what an African borrower needs to grow their business and expand into new markets and all of those great things, and what the lenders abroad are able to offer, it is not straightforward. It needs a helping hand to translate it or bridge the gap, as I call it. And unfortunately, a lot of consultancies like ourselves focus on the easier markets of raising debt in Europe. African transactions just are a bit more complex and take a lot longer to close. So it needs someone who can stomach the challenges that raising debt on the African continent will bring inevitably.
So, do issues like lack of sustainable electricity come to play in these situations? Like, I know we've just mentioned some of these businesses don't know about your company, so it's hard for them to even break through. But what are some of those unique challenges that you've encountered when working with those African businesses?
So that's a very good point. This specific example you raise can also be seen as an opportunity. So we're still focusing on the continent, and I keep calling it the continent. I keep calling it Africa, Raj. We're talking 52 or 54 different countries, right?
Yes.
Very, very different, huge market, not at all homogenous.
Yeah.
But lack of electricity, electrification rates are very low, or one of our favorites, lack of access to mobile telephony and the internet. Those are actually opportunities. There is an enormous amount of developmental debt, impact financiers who target especially those kinds of projects. Anything to do with electrification, bringing utilities, telephony in rural areas, semi-rural, peri-urban areas is absolutely top priority. I would add to those sectors also anything to do with healthcare, e-learning, sort of education, and anything that will help leave some value in the agriculture chain on the ground, on the continent, rather than shipping raw materials to be processed in Europe, setting up processing plants on the continent, leave some of the value add there. Those sectors, which might sound quite basic or early stage in the development of a country, are an absolute priority. So there's a lot of funding available from a variety of institutions, including the ones I mentioned, impact and development funds for those sectors. So that's not the challenge. The challenge might be regulatory environment, or which, to translate it into something meaningful, getting all the right licenses and authorizations and approvals from government authorities. A lot of red tape and bureaucracy for a borrower to be able to demonstrate to lenders, yeah, we're authorized, we've got all our ducks in a row, now all we need is your funding to go and deliver our strategy. That's a big challenge. Another one I'll mention, which is a pet peeve of mine, is the fact that these impact lenders, bless them, they do great things. Development banks, again, multilaterals, all of these guys who have deep pockets to fund these fast-growing countries and help develop the economies. They have very stringent requirements relating to protection of the environment. So environmental, social governance is a big topic. I can spend an entire podcast talking just about that, so I'll leave it there unless you have a specific question, but that's another challenge.
Yeah, that's good. I think a lot of companies in Europe, Ireland especially, always focus on the ESG, which is the environmental social governance. So it's good to see that it's being enforced into these situations. Let's be real. I do understand that African countries or companies they're not even seen on that radar yet. So they need the enforcement to a certain degree. That being said, I'm curious about the lenders. Do they have just specific processes that decide if the borrowers follow through those processes, they would get the loan? Or does it come down to a decision maker who looks at it and is based on intuition? Or how does it work in that situation?
Super good question. I'm going to put the lenders into two categories, if I may, and answer that question for the two categories.
Okay.
So the first category are the commercial lenders. So these are your normal banks like Bank of Ireland, AIB, although those two don't specifically focus on Africa. So we have other maybe household names like HSBC, Citi, Standard Bank, Standard Chartered Bank, those kind of guys are international lenders that have appetite to lend into some of these riskier jurisdictions on the African continent. They take a very risk-averse approach. They take a very detailed, credit-focused due diligence approach. What that means is they look at the company, its merits, how its cash flows are doing, what its prospects are in terms of its market growth, the competitive landscape, its relationship with suppliers, everything that a bank here in Ireland or anywhere in Europe would do exactly the same assessment. So these commercial banks take the same approach irrespective of which country they're lending to. And so that by default means that they can only lend to the more mature, more advanced, developed borrowers, even on the African continent. But they take a credit risk approach. That's the first bucket. The second bucket are the impact and developmental lenders. So here examples would be the European Investment Bank, or indeed the development banks of several of the European countries like France's Probarco, Germany's DEG, etc. I will put the IFC in there, the International Finance Corporation goes in there. So those guys lend as a policy decision, which means they say, right, we want to help develop Africa. Within Africa, we identify X number of countries. Within those countries, we identify these sectors. Very often it's the utilities, financial institutions, the agriculture, those kind of sectors. And then within those sectors, they do their research and they identify which companies are fast growing, have good prospects, and are good candidates to lend to. The credit assessment is an afterthought or comes secondary. They are policy lenders, which means that they can take much greater risk.
Yeah.
They do take a lot more time to assess a project, but they can take more risk because their goal is to help in the development, sustainability, job creation that their funding will achieve through these projects. They, of course, they want to get their money back. They are lenders, so they want to be repaid. So that is still a primary focus, don't get me wrong, but their approach is different. They will lend longer tenors, so for more years. They will lend at cheaper rates. It's not quite concessional or easy to access funding. It's still a protracted process, very protracted process to get money out of development banks. But they can look and fund projects that commercial banks would not touch. It would just be too early stage for them.
Interesting. So let's talk about the numbers like you would. What would be the average range of interest, because they are both lenders, of interest that the commercial banks would give compared to the average that the investment ones would give? Is it very high? Is it low? What's it looking like?
It's a difficult question to answer, Raj, because in each case is very, very bespoke. Lenders will take into account the risk of the country before they take account the risk of the borrower, etc. But ballpark, just to answer your question, as an example, where a commercial bank for let's pick a project in, DRC, Democratic Republic of the Congo, would charge an interest rate of 10, 11, 12%.
Okay.
A development bank could come in at 7%. So the difference is the second part of that is that the commercial banks will want to start seeing principal repayments sooner rather than later. So they give the borrower maybe a 5-year loan, and that first year is only interest. After that, it has to start amortizing. So principal repayments need to be made. So it's all repaid by year 5. The development banks, who are already cheaper, might give 7 years or 10 years. They want to make sure that the borrower is investing, and is not pressured to repay them. And so they might give the first 2 years as grace on the principal. So you see the terms are a lot more relaxed, both in terms of the interest rate charged, but also how long the loan can be outstanding. And the third area where the development banks and the impact funds are more relaxed is that a normal commercial bank, just like Bank of Ireland, just like AIB, they would want security. They want physical assets. What is this borrower building? A factory? Great. We would like that as collateral, please. And in many instances, indeed, when it's as tangible as that, the development banks will ask for the same. But many other instances, for example, rolling out little towers for telecoms towers for rural areas to get their first access to mobile telephony, it's fiddly and difficult to take security over that. So those lenders will lend without collateral at all. That is unheard of in commercial bank terms.
Yeah.
But I will stress, it all sounds lovely. I will stress I have aged decades dealing with these development banks. It is a protracted process. It's a process you can't bypass. They have their own internal procedures and boxes to tick, and the way they do it themselves and their policies they need to abide by. It can take a year to get one of those loans, whereas it can take 3 to 4 months to get a loan from a commercial bank on the African continent. Obviously, it's faster in Ireland. So it's not all.
Yeah. Well, when it comes to the baseline requirements of the size of these companies. We understand that there's a huge market in Africa, so some of these companies could have grown. They found a problem to provide solutions for, and they've grown to a specific growth rate where they have maybe, I don't know, $5 million worth of revenue. Now, my question first of all is, I don't, maybe just a ballpark, but what would it be as the baseline requirements for companies that's, the commercial as well as the development ones would deal with? What's the minimal? Is there a minimal, or is just maybe in terms of volume of trades?
Yeah. So again, two different buckets. Commercial lenders versus development lenders the answer is very, very different. So commercial lenders, without getting too technical and boring your listeners,
Yeah.
the ratio is not the amount of the loan does not depend so much on the revenues of a company. It depends on their cash flow, specifically a metric called EBITDA, and it will be 3 times EBITDA is probably the maximum. So if the company is generating, say, 10 million in revenues and 5 million in cash flows or EBITDA, a commercial bank might lend to them 15 million, so 3 times that EBITDA. So that is commercial banks. It's very simple formula. You literally do not bother approaching the commercial banks unless you have positive and growing EBITDA. Positive and growing cash flows. The development banks, the impact funds, are unique in that they can lend to a company before it's cash flow positive. There have to be proven revenues, so no startup can ever get funded with bank debt. Startups get funded with equity, either friends and family or venture capital, or eventually private equity when they're larger. Bank debt only comes in when it is proven revenues and on a trajectory to generate those positive cash flows, so that positive EBITDA. And in those instances, if the cash flows are not yet positive, so the company needs maybe another year or 2 years before it'll break even for its cash flows, the lenders look at a different metric. They look at how much equity is in the business. And for every dollar of equity that's in the business, they will lend $2 of debt. So it's 2 to 1 ratio. So they take earlier risk than the commercial banks, much, much earlier risk. And the reason for that is back to what I mentioned, they're driven by policy. They're policy lenders, not credit risk lenders. Their view in life is to help bring bespoke, fit for purpose financing solutions where the commercial bank market is not available. Once a company is large, has lots of cash flows, all of the commercial banks are knocking on its door to lend, the development banks step away. They do not want to crowd the market. The commercial bank market is viable option, then they can't even get approval for a loan. They have to demonstrate that they're adding that value, i.e. the market has failed to support these companies, so we're coming in with our development finance.
So it seems more like a balance between aid, but also making sure those people have accountability and enforcing, useful use for their loan. I like it.
Spot on, absolutely spot on. There has to be a repayment of that loan for the borrower and the shareholders to be held, as you say, accountable. There's a responsibility there to pay it back. I will, however, add just one program which is really worth mentioning here, is that the European Union, the Commission of the European Union, launched a couple of years ago a program called Global Gateway, which is there to help digitize Africa. And they offer, through the European Investment Bank as its agency, they offer grant funding alongside the bank debt, grant funding that doesn't have to be repaid. And this is effectively subsidizing capital investments to help build infrastructure anywhere on the African continent where that is missing. So you know how we take for granted how we have a great broadband connection because we have fiber running everywhere and, every corner of Ireland, I'm sure. That is not the case everywhere on the African continent. In fact, there are major, major gaps, including gaps connecting countries cross-border. And so there is a very, very good program that the European Union has, as I say, Global Gateway, to help bridge that gap, to help digitize the continent.
Yeah, because in some, in some arguments, I would hear people say Africa hasn't really benefited directly from the aids that has been gotten from, large corporations or associations, because on one hand, aid is coming, but the trade value hasn't increased. So you could receive aid for 50 years, but the trade value hasn't increased. So they still export the raw materials, commodities from Africa, which means they get the chance to look good, but they are making much more. So understanding that, I always ask the question, where has this aid been going into? But it seems there were actual policies, because those who were giving this aid had to control over where the aid was going into, and they ensured this aid wasn't helping processing, helping build factories for processing or things like that. So they needed that dependency to stay on. But seeing what you just talked about, this seems to be a movement in the right direction. So are there more like this, or is it just one of these major bodies operating in this way?
It's the major body that we at EMFC are aware of and are working with.
Yeah.
There are other smaller programs. Global Gateway is large, as several billions available to digitize Africa. That is one sector that, whilst at EMFC we are completely sector agnostic, the telecoms, digital, ICT, TMT sector, whatever you want to call it these days, is one of our core sectors, because the developmental impact of it is just so immediately obvious. You stick a tower in a village that didn't have one, and all of a sudden, the GDP of a community skyrockets through the roof. So it's very tangible benefits, and it's one sector where government has obviously some impact, because they have to license the operators, but it's not like an electricity utility or a gas utility where there is 100% still government involved. So telecoms is one of those sectors where private funding, these development banks that I talk of, and impact funds, they can't fund government projects. It has to be a private borrower. So we see a lot of those projects. But I mean, you touch on something very important. I think the non-African world has also realized that aid for the sake of aid, yes, of course, when there are natural disasters and all these terrible things happening, aid floods in. But for a more sustainable, building economies that are sustainable, creating jobs that are not there just for today and tomorrow, but actually for the long term. The initiatives are import substitution is very important. Any import substitution project. We worked on a industrial chemicals plant being built in Sudan and Ethiopia a few years back. Import substitution was the big driver. So you don't have to import materials to make soap in Ethiopia anymore. You have the raw materials being created there. And then what we said at the beginning, the value add staying on the ground. So processing your coffee beans, roasters on the ground rather than exporting it to Europe to have that done. So those projects are an absolute priority.
Yes, that's beautiful. One other thing I was going to touch upon is, so I've worked with companies here in Ireland, in the US, where they don't prioritize things like SOPs or operational optimization until they reach a certain metric. So we're talking above maybe $1 million per year. And initially, when I started business, I always assumed you have to get all those ducks in a row quickly, hire the CTO, hire people under them to manage the books and make sure everything is running. But people seem to build $2 million businesses with just 2 people. You know what I mean? So I assume in Africa, it's going to be totally off the trail. So my question is, because one thing I know is outsourcing financial advisory, first of all, is a new thing in Africa relatively. So how do you navigate this challenge? And especially when working with CEOs, CFOs, who are ideally male-dominated older people.
Yes.
And there's something at Africa about don't talk to your elders this way. You know, they feel they know better because the African culture is about the older ones have more wisdom. You know, I don't think that has changed completely. So how do you navigate all of this?
So such an interesting question. Oh gosh, where do I even begin? So let's talk about the skills and the resourcing. So the standards of education generally in Anglophone Africa, where we focus our work, are actually quite high.
Mm,
You get certified accountants. So my counterpart, so my a point person, let's say, within a company is usually the chief financial officer, the CFO, or sometimes called the finance director. So that
okay.
skill set is there all over the continent. Again, I will focus on Anglophone, which is where we do most of our business.
Mm,
These are certified accountants, Raj, who know how to deal with, I don't know, payroll and their suppliers and how to talk to their auditors and all of that good stuff that a good finance director does day to day. The extra little added skill that generally is missing from the continent, and that's going to sound like a terrible criticism, but I've been doing this for 26 years, including 18 years in Africa. So I will say what is missing is the looking forward financier. So this is someone who will take the strategy of their board, and the board might be just, you know, two shareholders, right? It doesn't have to be a large company. Every company has a strategy. Where do we want to, what are we building? Where are we building it? Or where are we extending our services? Or where are we expanding to, right? So what's missing is taking the strategy that the board decides they want to follow for the business and creating a funding plan, an adequate funding plan for that strategy, to deliver that strategy in the next 3, 5, 7, whatever time frame the board outlines. And that's where
mm,
we come in. We complement the finance director or the CFO, the chief financial officer. They can focus on the day-to-day of helping run the business, and we focus on executing everything that needs to get done in order for them to successfully obtain a loan from one of these lenders that we talk about. The niche we have built over the last 14 years that I've had EMFC is to help them tap into that developmental money that we were talking about earlier. So that skill genuinely has been missing. I'm hoping that that is something that will evolve and develop. It reminds me, again, I've been doing this for a long time. 26 years ago when I started, I'm originally Greek, Raj. I
mm,
remember that was a skill that was missing in Greece. The Greek banking system
okay.
had to hold the hand of these borrowers and help them through the process. Lots of very, very good accountants, but couldn't look forward or didn't know how to look forward. So that's one challenge.
Okay.
And that is where a board, a shareholder, a CEO, a CFO of a company needs to think out of the box and acknowledge, okay, our job is to focus on operations, grow our sales. Let's hire someone that can help us just raise that debt. We don't have a large finance team. We don't need to have dedicated people here permanently on the payroll to help us raise debt that we need once every 5 to 7 years. That's outsourced to a third party. So it's a mature decision of a company to take to
Mm,
do that. I now unfortunately forgot the second part of your question. Oh yes, sorry. It's how do I navigate? So walking into a boardroom full
yes.
of inevitably men, it still is very male dominated, very
Yes.
hierarchical cultures. You're absolutely right. You approach it in a very respectful way, Raj. I
Mm,
myself, the team, for good or bad, we are predominantly women. For whatever reason, the MFC seems to be predominantly women. Don't ask me why. Well, it's not intentional. Um, you do take a humble approach. You walk into a boardroom full of all these men, sitting there as directors of the board or senior management, whatever it is they are, with a lot of experience in their sector, right? They have an enormous amount of experience of how to navigate their own jurisdictions, challenges, most of the time dealing with, I don't know, government authorizations and licensing, their operations, how to sell in their market. There's an enormous amount of experience.
Yeah.
Our job is to extract that experience, that information out of them and translate it into, I'm going to call it marketing material that goes to the lenders, that sells a story that we know the lenders will buy, the lenders will be happy to fund. And as long as the borrowers or those board members in the room understand that what we're trying to do is actually get all of that expertise that they're holding in their heads or in the papers that they share with us, in order to showcase the phenomenal business that they've built, and how to extract some really good terms of funding for them, then they play ball, and they play very well. It's a great pleasure. I don't know how to describe this. It is super satisfying to be sitting in a boardroom with senior management or board members, asking all the questions as part of our due diligence process, because we then need to, as I mentioned, prepare the marketing materials that go to the lenders. It is so satisfying to be asking questions and see them there and then in real time, evolving their answers to us. Things that clearly they have already thought about, but maybe had not put down on paper or have not articulated even to each other.
Yeah.
And that is, you're literally watching the company evolve into a stage where it becomes eligible for that debt financing from these development banks, because we know what the development banks want to hear and see, right? So our job is to extract that information, to deliver it to them in that manner. It's super satisfying to be able to see that in whatever size company.
Yes. Although it still begs to identify that it seems like until you get there, or until there is a need for that shift, most of the directors in this position are quite reactive, and maybe, allow me to say, this is common in anywhere, right? There's this element of imposter syndrome when it comes to areas that you lack expertise in. They might have expertise in managing the operations, but when it comes to acquiring a loan with the European association, they might not have that. And I'm just trying to know, do you find them being uncomfortable in really expressing that? Because it happens, but I want to know, are you struggling to get that collaboration easily? You get to the point where you see them really evolving, but before you get to that point, do you have to really struggle to pull those information out, convince them of the benefit of what you're really doing as well?
Absolutely. It's not, it is not the easiest thing in the world to agree or obtain agreement from a company CEO, CFO to hire us. And two things there. One, yes, just like in anywhere in the world, we deal with egos and insecurities. Yes. So if a financial director thinking, oh no, this is something I should know how to do, and who is this lady and her team coming in to show me what to do? Oh no, he will block us, he or she usually.
Yeah.
I keep saying he, sorry, I don't mean to offend any of your listeners, but most of these jurisdictions in those positions, mostly we deal with men. So you will always have those people, and that's fine. That's absolutely fine. We can't help every company in the world. Right at the beginning, I said to you, the biggest challenge we have is people don't know that our services exist. I wish there were more consultancies like ours on the continent. But once that trust is gained, and sometimes it's, the board will impose us. The board will say to the CEO and the CFO, hey guys, you are swamped. Hire this lady and her team, and just get on with it. And in other instances, which is super interesting for us, is that the lenders will tell the borrower, we love to lend to you. Remember, I mentioned development banks have a policy approach. You are our target borrower. We absolutely want to do your sector, you especially, but you don't know how to speak to us. You don't know how to navigate our processes. You don't have the resources. Here is Sophie and her team. You need to hire them or someone very, very similar to help you. And then those barriers break because everyone wants, we're all aligned. We want to achieve the same thing. Get that company the funding it needs as quickly as possible so it can deliver its strategy and grow.
Yeah, that's nice. Well, the reason why we had to dive deeper into that is just to make sure if those who are listening, they could speak to each other and understand. It's all about the issue on ground, and we have to remove our differences, especially when it comes to business like this. So thank you for breaking that down, especially. I was gonna also ask, have you noticed any shift, in the age group or, the mindsets we're talking about? Has it become, more, are we starting to see more young leaders in those positions?
Absolutely.
Okay.
Absolutely. And that mind shift, and that mind has shifted or is shifting. Absolutely spot on.
Yes.
There is something drilled into this younger generation that has been drilled into all of us when we were all at university or college, and that is teamwork, 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 which wasn't necessarily something the previous generation were taught. And so younger CFOs, finance directors, accountants are approaching it. I can't do everything myself. I'm not a gatekeeper. Why not hire an expert to do just this for us? It makes sense. Oh, and by the way, I can learn a couple of things because I've never raised debt from whatever the European Investment Bank before. And I have 2 junior team members who would benefit learning. It's personal development comes into it, which maybe the previous generation didn't see as important.
Nice. And in terms of the loan agreement, I understand that EMFC usually just helps in brokering these deals, but once the agreement has come to play, you back off and they have this relationship. So I'm curious, do you ever, maybe look into the companies afterwards to see their success story and stuff like that?
No, absolutely. Very, very often. So our job is from start to finish to execute the loan on behalf of the borrower. And of course, there's an enormous amount of knowledge in the company, its operations, everything. We are part of the team working, as I mentioned, with development banks. It could be even a year. So working very, very closely with these companies. So sometimes they will retain us for an additional 2 years after the loan is signed. Why? These lenders typically give the company 2 years to draw the loan in stages as they are building or rolling out whatever it is they are. And so having 1 or 2 extra people from our side to help each time there is a drawing of the loan. These loans come with information undertaking. So every 3 months, the borrower has to prepare, its accounts to share with the lenders. We help all of that. So that's one instance where sometimes we're retained a little bit longer than after the loan has been signed. But what happens most often than not, Raj, is that once the company's raised the loan, has drawn it, is plodding along quite happily, growing its business, within about 3 or 4 years, sometimes earlier, they're like, oh, we're growing too fast. We need a top up. Hey, Soph, can you and your team come and run us the add-on, please? So it's an add-on financing. So we've had companies come to us 5 times in the past 14 years, or 3 times. That repeat business, which was not something I expected when I set up EMFC, is basically the acknowledgement or the realization, what, EMFC has a niche expertise in one thing alone, raising debt.
Yeah.
The finance team have a million things they need to cover every day. Why not just outsource it? They know our business, they know our lenders, they know our loan agreements inside out, back to front. If there's any waiver, an amendment, or add-on, or top up, or rescheduling of any type, yep, Sophie and her team can do it. So yeah, we do, and that is phenomenal to see. When you pick up a company that had, $10 million of revenues, 6 or 7 years ago with 20 employees. Now they are 120 employees and 40 million of revenues, and we've been part of that growth story. Absolutely, I love it. Absolutely love it.
Beautiful. Is there any growth success stories that you could share with us? Anyone is fine with us.
Oh gosh, there have been a few. What are some of my favorites? Oh goodness. Oh, I don't have a specific one to showcase here. I'll tell you that whenever. So we do all sorts of sectors, right? Nigeria's biggest development bank, we've helped them raise billions. Great, whatever. They can do that without us. But when there is a smaller company that, for example, is rolling out fiber in areas that previously have nothing, and all of a sudden I know that our hard work has helped get basic mobile telephony in towns and villages, in rural, I don't know, whatever, Kenya, Uganda, Rwanda, DRC, that they never had it before. Oh, I sleep very well at night. I really do.
It's beautiful. It is.
Yeah. I love what I do.
Yes. Maybe you have space in your company. So I was curious because I've seen some situations where NGOs starts these it's a model, the goal is to help companies, but because certain companies haven't gotten to the stage that they can really take on equity. So I was curious, do some of these associations take on equity rather than collect back loan? So they take on percentage of the company. Does it happen at all, first of all?
It does happen. It does happen. So usually the type of companies that can borrow money are past their equity raising phase.
Okay.
But there is a little bit of an overlap when we come in to some of the earlier stage companies. You remember I mentioned earlier that sometimes they're not yet break even in terms of their cash flows. They have a proven revenues, they have their customers, etc., but they're not quite cash flow positive yet. That is on the cusp. That kind of business could benefit from additional equity, because as I mentioned, for every dollar of equity they raise, they can release $2 of debt. So it is not very common, but on occasion we do come across, and we work for companies at that stage. And there, as long as the same institution, as the one institution, does not both invest equity and lend money as a debt provider, as long as they don't do both, we're fine.
Okay.
So we're working right now with a company that is an internet service provider in urban areas at the moment, just in Kenya, that have no internet at all. So thousands of customers who ordinarily would have to use their mobile phone, so mobile data, which is super expensive, because they didn't have even aerial internet at home, let alone fiber. And these guys have tremendous growth ahead of them, because these are all neighborhoods that are deemed to be too low income for the big fiber companies to come and lay fiber. People are like, we're not going to incur the cost of laying fiber because we'll never get the returns. Our client is using different technology, which is more cost effective to go in, and they can connect thousands of homes, literally. Now, there's an enormous amount of growth still in that business, because these underserved communities, again, low income, they're not obvious candidates. And so whilst we have just helped them raise phase 1 of their debt, and we're working on phase 2, they are also raising equity at the same time. So for fast growing opportunities, Raj, in fast growing sectors, it is not uncommon to see equity and debt coming in, as long as the equity is there a minute before the debt, because the equity releases more debt, or you can leverage the equity with more debt, then the two can coexist. in my world, we only do the debt.
Okay.
Equity speak is a different language. It's a lot sexier than raising just plain old vanilla debt. So, better people than myself do it. But yes, it can happen sort of concurrently, as long as literally the equity closes a minute before the debt.
Interesting. Also, it sounds like you usually have to travel to some of these companies physically to work with them. So it's not a remote situation where you're working from home.
When people ask where I live, I usually say on a plane. It is true. You're absolutely right. But also, I mean, just picking the example of this internet service provider that I just mentioned in Kenya, even before agreeing to work with them, I flew down. Nairobi is one of the destinations that I go to quite often. East Africa is growing like gangbusters, so a lot of debt opportunities there, and a lot of the development and impact funds really want to lend into companies in Kenya, Tanzania, Uganda, Rwanda, all of these places. Anyway, flying into Nairobi even before signing up that client, where the CEO founder took me to these underprivileged neighborhoods and showed me exactly, connected how they've connected them with internet. He took me into 2 small businesses there that were able to operate because all of a sudden, they had internet, which the big operators in the country don't even come anywhere near their neighborhood. So when you see it with your own eyes, it gives you that extra energy and passion and desire to absolutely help. It makes it so much more real. So then when we are talking to the lenders about the opportunity, which, by the way, we absolutely say to them, you need to come and see the operation on the ground. We take them through these neighborhoods, up 7 flights of stairs to the rooftop of the building to see where the tower is that connects to the antenna, all of that. You see that they get a buzz. They leave and that's what we need to then go internally and sell to our own credit committees, our investment committees, to extend the loan. So that face-to-face is very important. But also the example I mentioned earlier, sitting in a boardroom with all these gentlemen that have all of that knowledge in their heads, unless you're sitting there literally real time extracting it from them. So our due diligence is face-to-face. It's not the same doing it over video or phone as we used to in the old days. So yes, there's a lot of travel. I enjoy very good status with airlines. I do travel a lot, it's true.
That's good. But I was curious of one last thing though. What's the major things that you've noticed is the reason why Eastern Africa seems to be causing such a buzz compared to maybe Western Africa?
So the economies of so 2 reasons I'll mention. The economies of Eastern Africa most recently have experienced a stability, including in their currencies, which is a big factor in scaring or not off lenders. So Ghana's CD, Nigeria's Naira have had fluctuations, which hasn't helped because the lenders, which I talk about, the development banks, the impact funds, they lend in hard currency, so dollars and euros. So they want to make sure that they can be repaid. Now, they have special concessionary programs to help in countries where the currency isn't very stable, but it's not common practice. So there's been a lot of focus on East Africa because of that reason. North Africa is well banked. To the Middle East, Arab banks cover that part of the continent very well. So in sub-Saharan Africa, East Africa is the hub. The second reason is the Francophone versus Anglophone in sub-Saharan Africa. Francophone Africa, debt available to Francophone Africa is a little bit more, I don't know who I'm going to offend here, a little bit more old-fashioned in that it is French commercial banks, not as many development banks, and it's literally just the language.
Yes,
currency in Francophone is brilliant because it's pegged to the euro, so you want you're safer there, but it acts as a language barrier. So even when we're approached by a company in Francophone Africa, I don't know, whatever, Senegal, Cote d'Ivoire, wherever, unless their internal information, their internal language, operating language is English, then we wouldn't be able to serve them as well. So sadly, there is a disparity there, absolutely. I think because of the language mostly.
Well, there is a lot there that has been unpacked, and we're glad that we're able to pick up, your brain on all these insights. So thank you again, first of all, for really coming on and giving us this beautiful information.
My absolute pleasure for listening to me all this time. My pleasure, Raj.
I know that you've had the opportunity to travel Africa well now, Have you been to Nigeria?
I have. Both Lagos and Abuja. I will take Abuja over Lagos anytime, my word.
I take it you don't like the aggression,
crazy city.
The traffic and everything. Yeah, it is crazy. High energy.
That's like it.
Packed in, yeah. Okay, so that's good. In that case, I was just gonna ask you, what do you imagine for Africa's future? So in your vision of a better Africa, what do you imagine?
That is very, very difficult. I would like to see some of that red tape be eased, the bureaucracy. That is a barrier to so many things, not only raising debt. I would very much like to see that. And if the grip of government eases a little bit, then it'll be plain sailing, because there's an enormous energy, so many entrepreneurs, so many good ideas, but so many opportunities starting from scratch or from an earlier position. So if that could be eased, the bureaucracy, the number of the paperwork and the time it takes to get the paperwork, then I see it plain sailing. But that's a big if, Raj. That's a big if.
Especially the time.
Indeed, it takes time. Absolutely. Yeah. But it's getting better. Again, I've been doing Africa, raising debt in Africa for 18 years. It's much better now. So there is hope.
I do feel technology has played a part too in helping this improve. Yes.
Absolutely.
There is hope. There is hope. We're excited. So that actually comes to the end of our podcast today. I hope I haven't, be asking you too many questions.
No, that was great. Thank you again for letting me talk so much about this topic.
Much appreciated.
I love what we do.
Yeah, and most of our listeners, I'm pretty sure, would, want to know where they can find more information about EMFC and any other information that can be helpful. So please, the floor is yours. Where can they, get more information?
I'm happy to chat to anyone. We have a website, but that says very little. I'm happy to chat to anyone. If you want to pass on my contacts, Raj, I'd be more than happy.
Okay, but if they want to find you publicly as well, how can they find you?
Oh, on LinkedIn, Sophie, if you can spell my surname, is Papasavva.
Yes.
Or Sophie at EMFC on LinkedIn. That's where I am. Absolutely, drop me a message on that. I'd be happy to.
Awesome. Thank you so much. It's been such an honor. Thank you, Sophie.
Thank you. Bye.
Take care. Bye.